interesting point as well there, actually, in terms of anything that you can do now directly impacts the asset in terms of immediate returns by implementing projects that give you a cash return, but equally that pathway to show the next potential acquirer that, as you've mentioned, the due diligence has taken place and this is how it should be delivered. So when it comes to that stranding year or prospective acquisition point, there's not money being taken off the table because it's deemed as too risky. It's a pathway to move things forward.
It is a pathway to move things forward. I think about it a little bit more simplistically than that even. If you actually take a step backwards, what I think a lot of engineers, asset managers, building managers, etc. fear is that it nearly becomes too complex, because it's okay if they think, well, it's old stock, it's kind of going to be stranded anyway, there's nothing I can do, I'm just going to put bad money after bad money. What I prefer to actually talk to people about is that, listen, if you're going to spend £1 million a year for the next 5 years before it becomes stranded in your eyes, then you're better spending £500,000 if we can put some energy efficiency improvements in. And then ultimately, you actually, even in the worst case, you extend the life of that asset, to a point where it can be, thought about differently and will be seen more valuably by somebody who will come into it. So it is ultimately about taking that incremental value year by year, and any board or any investment committee will be well used to seeing, okay, the net asset value or the net present value of that saving over those years, in many, many instances, if not all, will more than compensate for the small outlay of cost that they have to do to make improvements to any asset class that we typically see.
Yeah. And which obviously gives a direct impact on the net operating company for the income for the asset as well.
It does.
Within year.
It does, because, I mean, at the bottom line, most multiple occupancy buildings, they will have, a fixed tenancy agreement, a fixed agreement that will include for utilities and the like. And the bottom line is, if the cost that is being prevented by the asset owner is saved, that plays directly to gross margin of that business. And therefore retained value, and therefore makes the margins and the attractiveness of that ongoing hold period, more relevant. And equally, at the point of sale, makes that kind of ability to actually make money from that asset more attractive for anybody coming in.
Yeah. And so one of the other challenges that we're hearing quite frequently as well is that, especially organisations with large portfolio of assets, the resource is relatively limited, and the resource is spread so thinly in terms of having to do reporting frameworks like CREM and GRESB, EPC reports, all of these other certifications, that is that directly attributing any value to the overall process, do you think, in terms of how you achieve net zero?
Well, there's a certain de minimis. It's like, if you play this to our houses at home kind of thing, does it have to have an EPC certificate in the UK? Yes. It was one of those. Does it really add much value? Probably not. If you were to say to an interested party coming in to invest in an asset or acquire an asset, well, we haven't bothered with CREM or we haven't bothered with GRESB, well, guess what? You're not going to attract a premium. That said, I would say that is absolutely the de minimis level of where you need to get to. It's a base level beyond which you then have to add value. So, likes of GRESB and CREM will ask about, certain facets of the building infrastructure, where you are, what's the environmental status, insulation, etc., etc., etc. But unless you can then demonstrate beyond that what you're doing to enhance the value and equally on that journey decarbonise that asset so that it holds itself as a prime real estate location for a much longer period, that's ultimately where you have to drive to.
Yeah.